Good morning or good afternoon, depending on where you're joining us from. Welcome to today's webinar, which is going to be an Unemployment 101 session for nonprofit employers. My name is Nicole Korn, and I am the Director of Unemployment and Solutions here at 501. A couple of housekeeping items before we get started. First thing, I'm going to leave everybody on mute just to keep down any background noises or distractions, but if you have a question during the webinar, feel free to type it into the Q&A questions box, and I will stop a couple of times during the webinar to check that. Otherwise, if you're not comfortable asking the question online, feel free to jot down my email address here, and you are welcome to reach out to me directly after the webinar. I'd be happy to answer any questions. If you're joining us today because you need some continuing education credits to maintain your SHRM or HRCI HR professional certification, all you have to do is after this webinar, you'll get a survey and you just need to complete that survey. And once you do that, give us about 24 hours or so, and we'll make sure we send you those codes. All right, so with that, we have a lot to cover, so let's hop into the agenda. Today's session is meant to be, kind of an overall understanding of how unemployment works. And to give you some of that foundational information. Obviously, there's a lot of state nuances that we're not going to be able to get into, but you should leave today with a pretty solid understanding of how unemployment works. So we're going to start off with just a brief history so that you can kind of understand how the program was built and structured. Then we'll move on to chargeability and liability. Then we'll talk about the different types of separations and some adjudication strategies, and we'll wrap up with just a couple quick tips for appeals and hearings. All right. So unemployment all began with the Great Depression. In 1929, U.S. financial institutions collapsed, and many companies began laying off workers, which caused the unemployment rate to skyrocket to over 20% nationwide. And so it was this event that prompted our government to try to find a means to provide relief to these impacted individuals who had lost their livelihood. So on August 14th, 1935, President Roosevelt signed the Social Security Act. And the Social Security Act contained provisions for elderly insurance, welfare, and unemployment insurance. So the U.S. unemployment program is federally mandated. However, the individual states can administer the program as they wish, so long as they meet 4 federal requirements. So the first federal requirement is the replacement of lost wages. So obviously the objective here is to protect workers from a temporary loss of wages. And while the amount that someone can collect is going to vary from state to state, unemployment is always meant to replace only a portion of a worker's earnings. So for example, if you're employed and you make $1,000 a week and you become unemployed, you're not going to get $1,000 a week in unemployment. And this is in part to provide an incentive to that unemployed worker to return to the workforce. Typically, unemployment benefits are going to be about 50 to 60% of whatever your average weekly wage was while you were working, up to whatever the maximum cap is in your state. So high wage earners may not quite hit that mark. The second federal objective that the states must meet is stabilization of national employment. And this objective creates an incentive to employers to retain their workforce by taxing them or charging them on their prior unemployment experience. So if an employer has a high level of chargeable claims against their account, their tax rate will likely be much higher than a company with little unemployment activity. And it's slightly different for nonprofit companies that are exempt from the taxes, but the underlying principle is the same. There's a financial impact for not retaining your workforce. The third requirement is stabilization of the economy. And so obviously the objective here is to retain some of the consumer purchasing power, hoping to prevent an economic downturn. So in other words, if someone has no money coming into their household, they're not spending any money out in the economy. So the idea is to stabilize the economy by providing some income while they're out of work. The fourth and final requirement is job placement. And this is why the state unemployment agencies are actually the primary job placement bureaus in America. So outside of these four requirements, each state administers their own unemployment program within these guidelines. And this is why regulations regarding eligibility, benefit amounts, and the length of time that someone can collect is going to vary by state. However, when it comes to eligibility, there are five criteria to be eligible for unemployment benefits that are the same in every single state. So, in order to collect unemployment benefits, you must be physically able to perform some kind of work. You must be available to work. So, you can't be going to school full time or backpacking through Europe. You have to be available. You have to be actively seeking work. And so, this is why if you've ever collected unemployment, you know you've got to report all of your job searches, proving that you are looking for work. You have to meet the state's monetary requirements. So this means you had to have worked long enough to be eligible, and you also can't be currently earning too much to make you ineligible. So there's a monetary piece to this. And then last but not least, you must be unemployed through no fault of your own. This last piece is really the part where the employer is the most involved. It's extremely subjective, and we'll talk more about what no fault of your own means when we get to the different types of separations. Okay, so unemployment really hasn't honestly changed that much since 1935, and that was until President Obama passed the Trade Adjustment Assistance Extension Act of 2011. And this was major legislation, and it resulted in new regulations to promote unemployment insurance integrity. These new regulations went into effect in 2014 and changed the way employers need to view their role in the unemployment process. Previously or historically, employers made a choice between responding or not responding to unemployment claims, and they would often only respond if their wish was to have benefits denied. But moving forward, employers are actually required to respond to all claims if you want to remain in compliance and avoid potential financial penalties. This federal legislation stipulated that the state unemployment agencies must prohibit relieving the employer of charges when both of the following conditions exist. First, the unemployment benefits were paid improperly due to a failure of the employer to respond timely or adequately to the state's request for information. And second, the employer has established a pattern of doing this. So what does this mean exactly? Well, prior to 2014, employers could just send a very generic response to an unemployment claim. And if the person was awarded benefits, they could appeal it. And then they put all the effort into gathering all the details and the supporting documents for that unemployment hearing. And then if they were successful in getting the decision overturned at the hearing, the state would then owe the money that had been paid out already back to the employer, regardless of any fault that they may have had in the state making an incorrect decision. So post 2014, the states are required to deny reimbursement of those improper payments if the employer has a pattern of doing this. Now, they may stop paying the benefits as of the hearing decision date, but you will not get back any of the money that was already paid out. It may seem a little harsh, but actually, if you think about it, these rules are beneficial to all parties involved. If you provided the necessary details and documentation up front, the state will make a better initial decision. It's going to result in less appeals, less hearings for both you and the claimant to attend. The states are less likely to become insolvent because there will be less improper payments being made. And if you think about it like this, an individual could collect thousands of dollars by the time the claim gets to a hearing. Okay, so if it's initially they're awarded, you appeal it, they start collecting, and they could have collected thousands of dollars by the time it gets to the hearing. So if you wait to the hearing to start providing all of the necessary information that would have initially disqualified the person, the state now has to try to go back and collect all that money from someone who is unemployed. Yeah, good luck. So in most states, the employer doesn't get their money back until the state recoups it. And I've seen it take 5 to 7 years before those credits start coming in. And and sometimes the state will end up waiving that repayment due to hardship. So it really is in your best interest to respond to all unemployment claims at the initial level timely and adequately so that you're getting the best initial decisions and allowing them to apply the laws appropriately. Now, unemployment claims are 100% funded by employers, either through taxes or direct reimbursement. It's not uncommon for people to believe that they pay into unemployment and it's a benefit or an entitlement that they're owed, but this is actually not the case at all. There are 3 states that do have a small employee contribution that they might see on their paycheck. That's New Jersey, Pennsylvania, and Alaska. However, these 3 states that have these contributions, those contributions go directly to the states for the cost of administering the unemployment program. None of that money contributes to the funding of the unemployment benefits. The benefits are funded by the employer 100%. Now, when it comes to funding these benefits, there's 2 types of employers. You've got a merit-rated employer, also known as tax-paying, or you could have a reimbursing employer, also known as self-insured. So merit-rated employers could be a for-profit or nonprofit employer. They're going to be issued a tax rate every year in every state that they operate in. That rate is then going to be applied to a designated wage base that varies greatly by state. So I'll give you a state example. In the state of Oregon, the taxable wage base right now is $56,700, and you could be assigned a rate all the way up to 5.4%. So let's say this year you're assigned a rate of 4%. That means you're going to pay 4% on the first $56,700 that every employee earns. That would be about $2,268 per employee. So let's just for round numbers say you have 100 employees. That means you're going to pay the state $226,800 this year, whether you've had a single unemployment claim and you never get the money back, right? You don't use it, you lose it. Now, when determining your tax rate each year, there are lots of socialized costs that go into that. So it's not just determined by your own experience or usage. You could be doing great, but if other employers in your state are not, your rates could still go up due to those economic factors. Plus, most states use a look back period of 3 to 5 years to determine your rate. So one bad year could affect your rate for several years after. Basically, they have to refund the system at a higher rate in which the money is going out, same as any other insurance program. Now, the other type of employer is a reimbursing or self-insured employer. To be eligible to do this, you must be either a 501c3 nonprofit organization, a government agency, or a tribal organization. Being a reimburser can be particularly advantageous for several reasons. You will pay only for actual benefit payments issued. You will avoid increased tax liability due to an unfavorable economy, and you will avoid the tax assessments and socialized costs that go into those rates. So let's use this same example of Oregon. The Department of Labor published that the average person in the state of Oregon will collect around $8,400. That's the average claim value. So let's say you have 100 employees and you separate 10 of them this year. Out of those 10 people, a lot of them quit. Only 4 of them maybe are eligible for benefits. Out of those 4 people, if they averaged 8,400, we're talking about $33,600. So you would pay the actual $33,600 that those individuals collected versus that $226,800 that you would have paid in taxes. So depending on your organization, your size, your turnover, etc., if you're good at controlling your turnover and those kinds of things, being a reimburser can be very advantageous. Not to mention, post-pandemic, unemployment has been at all-time historical lows. It is starting to sort of normalize now to like a pre-pandemic level, but for years, claims were extraordinarily low. Meanwhile, most of the states have been raising the taxable wage bases, raising the tax rates in order to compensate for everything that happened during the pandemic. And so reimbursers, even though it was scary during the pandemic, they were really enjoying only having to pay for what they were using in these historical low unemployment times. Okay, so this is just a real quick thing that I like to show because most studies that attempt to quantify the cost of turnover usually only look at the cost of hiring plus the cost of training new employees. They almost never look at the cost of an unemployment claim, and they absolutely should. Unemployment is a real cost. It goes directly to your bottom line, and it is somewhat controllable, and that's what we're going to talk about today, is some ways to control those costs. Like, look at the state of Washington. Right now, the maximum liability or the maximum claim benefit amount for high wage earners in that state, $1,152. So one claim could cost you almost $30,000. This is why it is important to pay attention to your unemployment and to manage it as best as you can. So now let's talk about chargeability and liability, and then we'll get into some questions. But one of the most common questions we hear is, why am I responsible for this unemployment claim? I don't, they left here a year ago, and how much am I going to have to pay on this claim? So let's talk about how the state figures all this out. So the first thing that the state is going to do when someone files an unemployment claim in every state is they're going to establish something called the base period. The base period in almost all states is going to be the first four of the last five completed quarters. The two exceptions I'm aware of are Massachusetts and Minnesota. They have to be different. They use the last four completed quarters, but almost every state uses the first four of the last five completed quarters. So if you look at this chart, it's meant to help you kind of figure this out really quickly. The boxes to the far right that are not shaded, that have the arrows pointing to them, that's your filing quarter. And then if you look to the left, the shaded in gray is the base, what the base period would be. So right now we're in the month of May. So that's the second box down there on the right, the unshaded box. And you will see that this, I mean, this is not a completed quarter. We're still in the second quarter. It's not completed. And the base period is going to be the first four of the last five completed quarters. So Q1 of 26 won't even be in the equation. We call that the lag quarter. So your base period for anyone who files right now is actually calendar year 2025. So that means that someone who left your organization in February 2025, if they file a claim today because they got let go somewhere else, maybe you could still be in that look back base period. You could still be chargeable for the claim. Now, you might be wondering why every state doesn't keep it simple, like Massachusetts and Minnesota. What's the point of this lag quarter? Why wouldn't Q1, the most recent completed quarter, be used? And there's actually a really good reason for this. Um, if you're familiar with your payroll reporting, every state gives you about 30 to 45 days or so after the end of a quarter to report your wages to the Department of Labor. Well, they have to have those wages in order to determine how much someone is eligible to collect, what their average weekly wage was, all of that, which employers might be included in the claim. They've got to have all that data. So if someone were to file the first week of April, you haven't reported that information for Q1 yet. They wouldn't have it. So in states like Massachusetts and Minnesota, it's a real pain when someone files early in a quarter because the state's going to send the employer a very cumbersome, annoying wage questionnaire that they're going to have to fill out because the state doesn't have the info yet. So there's actually a really good reason for this lag quarter and why the states look at the first four of the last five completed quarters. So what is the point of the base period? Why is this the first thing that they do? So you'll see on the left side of the screen, it's going to tell the state a lot of things. Number one, that base period is going to tell the state, has the claimant met the minimum wage requirements? So they're going to look at their earnings during that period and see if they met the minimum thresholds to be eligible. Number two, it's going to tell them how much the claimant might be eligible to collect and how many weeks they can collect. It's going to tell them which employers will receive a claim and what type of claim they'll receive. And it's going to tell them if the claimant is found eligible for benefits, how much is each employer going to pay. So as you can see, the base period is very critical when it comes to unemployment. It's almost everything. So let's go through a specific example. Okay, so when looking at this graphic, this is just another way of kind of looking at the base period. You're going to see that there are three companies involved in this claim. So you see that big red arrow here. We've got the claim filed quarter. So we'll just for, the previous example, we'll say it's May, filed in May. So Q1 here is going to be that lag quarter, that yellow sort of lined out section to the left. So your base period is going to be this grayed out 4 boxes to the far left. And for this example, we're going to say it's calendar year 2025. So you can see that there's three companies here. We've got Company A. Company A was the company responsible for separating them, why they filed the claim. But you can see that their employment extended all the way back to the base period. So Company A is going to be a last employer and a base period employer. Company B and Company C are going to be base period employers only. So Company A is going to receive a last employer claim, which is going to be used to determine the individual's eligibility based on their most recent separation. They will also receive a base period notice because they have some wages back there in the base period. And that base period notice is going to address their financial liability. So we've got two forms. The one form is going to address eligibility based on separation, and the other one's going to address liability. Some states combine those forms, but in general, this is how that works. So companies B and C, they're only going to get that base period notice, letting them know that if this person's found eligible from their most recent employer, they're going to have some liability on this claim. Now, in general, base period employers are not going to get to protest based on separation reason. And here's the reason why. So the state is not going to penalize someone for not filing a claim because they quit a job a year ago. So if they quit your organization because they got another job and they went and they worked somewhere else and they worked there for 6 months or so, and that employer then lays them off, the state's not going to just qualify them because they quit a job, 6 months ago. They were laid off, and that's what prompted them to file the claim. So they're going to be eligible. Now, if you're a tax-paying employer and you pay into those socialized pooled funds, the state will not charge, if you're like the base period employer only and they quit for another job, you can protest and say, don't charge my experience rating with this claim, because they voluntarily quit. And the state will usually relieve you of charging your experience rating because they're going to take the money. They're still going to pay the claimant if they're eligible, but they're going to take the money out of those pooled funds and those socialized pools of funds that you pay into when you're a taxpayer. Well, when you're a reimbursing employer, you only reimburse for actual benefits. You don't pay into a pooled fund. And so you have to pay your portion of those base period claims when you're not the last employer. Now, seems unfair? Well, sometimes it works in your favor. So, in this scenario here, you can see, I'm about to go through the dollar amounts, that the oldest employer here actually has the biggest chunk of the liability on the claim. But you could then be in a later scenario, you could be Company A, and maybe you are the one that laid the person off, but you're going to get the least amount of charges. So it works both ways. So in this example, we're going to say that the wages reported in the base period between all three employers was a total of $50,000. So if the claimant is found eligible, their weekly benefits probably going to be somewhere in the ballpark of $480 a week, or a maximum total of $12,480, over that 26-week period. Most states pay 26 weeks. Not all, but most. So 36 out of the 50 states, again, I told you there's a lot of state nuances, and unfortunately, we can't go through all 50 states' nuances, but we're going to go through the majority of what states do. Majority, 36 out of 50 are going to charge proportionately based on the wages that are paid in the base period. So in this example, if the claimant's eligible, you can see Company A paid 5,000 of the total 50,000 in wages, or 10%. So they're going to be responsible for 10% of the benefits. Company B paid 20,000 or 40%, and Company C paid 25,000 or 50%. So of that 480 a week, Company A is going to be responsible for 48 of that, company B 192, and company C 240. And so that is how the majority of the states do it when they do it proportionately. Um, I'm going to give you some other quick examples of how the other states might do it if you're not in a proportionate state. The other common one is called inverse chronological order. Kind of works the same way, just the way they do the charging is different. So in inverse chronological order, they're still going to determine each employer's total liability and percentage. But what they're going to do is they're going to charge the most recent employer first until they hit their max liability. Then if that person's still unemployed, they'll move to company B. And then when they hit their max, if that person's still unemployed, they'll move to company C. To me, actually seems more fair than the proportionate way that the majority of states do it. So if using these same numbers, company A $48, that means their total max liability or 10% of the claim of that 12,480, right, would be $1,248. So company A would actually get charged the full 480 a week until they hit their $1,248 maximum liability. And then it would move to company B. Their maximum liability is $4,992 because they're paying 40% of the benefits. And so they pay 480 a week until they hit that. And then company C is 6,240. So once they move to company C, they'll charge them 480 a week until they hit their maximum benefit or until they go back to work and are no longer collecting. Um, Another common one is the last 30-day employer. Now, Illinois does it like this. Oh, by the way, some examples of inverse chronological order would be like Massachusetts and Iowa, and I think maybe Colorado. Um, Illinois does last 30-day employer, and the way they do it, and again, seems more fair to me than the proportionate way. If you're the last 30-day employer, so you've employed them for 30 days and you're the one that separates them, you're going to get 100% of the charges if you also had wages in the base period. So in this example, company A would pay 100% of the benefits because they're the last 30-day employer and they've got some wages in the base period. Now, if you're the last 30-day employer, but maybe your employment stops somewhere in the lag period and you didn't quite make it back to the base period, then you're going to be responsible for 50% and the state will cover the other 50%. And then there's one other weird one that the only state I know of that does this is New York. New York charges the last employer that separated them the first 7 full weeks of unemployment benefits, and then they take the rest and they break it out proportionately amongst all the base period employers. Okay, so there are some exceptions to this base period protest rights rule. So when I said if you're a nonprofit reimburser, you can't protest base period claims when you're not the last employer. There are some exceptions. There's always exceptions. I've got 2 slides here. I'm not going to read these all, but you can download you're going to get a copy of the presentation after today's thing. And so you can look through it and see if your state is on here. There are some states like Colorado, Iowa, Michigan, they allow you to protest all base period claims when you're not the last employer and even if you're a reimbursing employer. Um, then you've got states like New Jersey that only gross misconduct. So if it's like violence, theft, something like that, then you can protest the base period claim and try to get those wage credits removed. States like Pennsylvania have something called a solvency fee. So every year they're going to send out a notice that says, hey, if you pay this one-time fee, you can then protest your protestable base period claims for the whole rest of the year. And basically you're paying into a pooled fund like if you were a taxpayer, it's like a one-time payment. You're basically buying the right to protest claims. All right, so before we get into types of separations and adjudication strategies, I'm going to take a quick opportunity to check the questions, the Q&A box. Oh. Okay, so here's a question. I work for an employer in New York and we terminated an employee at the end of January 2026. They applied for unemployment. I returned the notice of protest with the termination write-up and completed the questionnaire. We still have not received a notice of determination. I have called several numbers, but the New York employees keep giving me a different number. I've even faxed a request for a notice of determination. So I guess my first question is, are you using the claims administrator to help you with these things? Because as a member of our organization, should be going through our claims administrator, but nonetheless, um, I bet, okay, so there could be two scenarios here that's causing this. A, the state could just be really far behind, although January seems like a long time. They do sometimes run slow, but that seems like a long time. The other thing is that the employee may have stopped pursuing the claim. So you're not going to get a decision if the claimant stops pursuing the claim. So if you submitted your info, they submitted their info, your info may have prompted the state to go back to that claimant and maybe ask some follow-up questions, and maybe they kind of knew they had violated a policy or whatever, and they weren't going to get unemployment, and maybe they just kind of let it go, or maybe they found another job and just kind of let it go. If you don't get a decision, it's not necessarily an issue unless you see charges. So if the Q1 charge statements should already be out, they came out at the beginning of April. So look for that employee. If that employee is on the charge statement, then the charges should have been protested, stating that you have not yet received a determination. Um, Again, if you're working through our claims administrator, they would automatically do that. That's an automatic red flag protest if they get charges and there's no claim. But if we need to talk about this offline, feel free to contact me. Again, my email address is ncorn@501c.com, and we can certainly look into that a little bit closer if we need to. But that would be my recommendation. All right, moving on to separations and the types of strategies. So first thing I want to say is the time to win an unemployment claim is not when you receive the claim in the mail or via an online portal, whatever. Because it's too late at that point, right? You can't go back and collect all the necessary documentations and statements and details and warnings and all of that stuff that you need to win a claim. The time to win the claim is through the entire employment process. And so what we're going to talk about today are some best practices. We're going to talk about what the state's looking for, types of things you should be documenting so that you can win that claim. You have everything in your personnel file before that claim is ever filed. And I just want to say that unemployment is very, very gray. It is not black and white. Every scenario is going to be evaluated by the details, and every detail matters. So let's just talk through these. So first and foremost, there are three types of job separations that are going to be recognized in unemployment adjudication. Every single separation is going to be lumped into one of these three categories, okay? Once they determine which category, that's going to dictate the flow of how the claim is adjudicated. It's going to determine who has the burden of proof on the claim. So the state's going to look at things to determine which bucket it goes in. They're going to look at things like who was the moving party that initiated separation from employment. They're going to look at things like, was continuing work available? Okay, so let's look at these. Some of these are obvious, but some of them are not. So for discharges, obviously, if you fire someone for violation of policy, gross misconduct, for cause, whatever, we all know that that falls into the discharge category. But what you may not realize is suspensions. Suspensions are going to be adjudicated as a discharge. You haven't actually discharged them, but you are the moving party that separated them from work, okay? And they're not allowed to continue working. So that is a discharge. Mutual agreement, the whole like, let's just agree to part ways. I'll let you quit instead of getting fired. That is a discharge for unemployment purposes. Your employment records can say whatever you want, but when it comes time for the unemployment claim, it will be adjudicated as a discharge. Voluntary separations, obviously, if they quit or they just abandon their job, those are voluntary. But leave of absences, those will be adjudicated as a voluntary quit. More times than not, a leave of absence is going to be initiated by the employee, and therefore it is going to be considered a voluntary separation or a voluntary quit, even though they haven't technically been separated from work. Not permanently, anyway. Lack of work. Layoffs, obviously, positions eliminated, reductions in staff. But the ones that also fall into lack of work category would be things like temporary work, seasonal work, contract work that ends, reduced hours. All of those things are going to fall into that lack of work category. So let's talk about each one in a little bit more detail. We're going to start with discharges. Discharges are obviously going to be the most complicated for you as the employer. So in the event that you must discharge an employee, the burden of proof for unemployment will be your responsibility. Earlier, we discussed that unemployment is for individuals who find themselves unemployed through no fault of their own. Well, in the case of a discharge, the employer will need to prove that the employee was separated for misconduct in order to be relieved of charges. Now, the state defines misconduct as a deliberate and willful disregard of an employer's interests or repeated violations of a known company policy. So keep in mind, it is very possible for an employee to be discharged for what you would consider cause and it not meet the state's definition of misconduct. So in essence, you could have made a solid business decision, followed all your policies, separated the employee appropriately, yet they may still qualify for unemployment. The state's rules are not your rules, okay? So let's walk through some of the discharges that are going to be a little bit trickier. So the first one we're going to talk about is something called an isolated incident of an isolated incident. Okay. So if the individual is terminated for a policy violation, but they didn't have any prior warnings for a similar infraction, the state will typically rule it as an isolated incident of poor judgment. So this comes up most often when employers have a progressive discipline policy and their violations were what we refer to as a mixed bag. So maybe they had a verbal warning for being out of uniform or dress code, and maybe they had a written warning and a final warning for attendance. But then maybe their final incident that resulted in termination was a technology violation or a violation of social media company policy, something like that, right? The state is going to want to see at least one prior warning that aligns to that final incident. It could be verbal, but one prior warning. So what happens is if this person just got a bunch of coachings and a bunch of warnings that according to your policy has to result in their termination because they've had too many write-ups, but nothing lines up and the final incident isn't gross misconduct, it is very possible that the state could rule it as an isolated incident of poor judgment, meaning, yeah, they broke a rule, but it was just poor judgment and they didn't realize that this was going to result in their termination. Again, everything in that is gray and it is going to really depend on the scenario, which is why all of the details are so important. So when we get to what types of documentation you need, we'll talk more about that. The next one is going to be, that's a little tricky, is a good faith error. So this is going to be when the employee violated a policy, but if the state believes that the employee thought they were doing what was in the best interest of the company, whether they had other warnings or not, the state is usually going to rule that as a good faith error and not deliberate misconduct. So let me give you an example. I used to work on claims for a very popular retailer that we would all know. And they have very strict rules around meal break violations because, they're very susceptible to lawsuits and legal stuff. And so they really watch this policy very closely. And that you will get fired for not taking your meal breaks if you're an hourly employee and you're violating that. Now, what you can see happen is even if someone's been warned before about this, if the line is out the door and all the other employees are MIA or they all called in sick or there's a shortage and there's no one to wait on the customers and this employee feels like they kind of get stuck behind the counter and so they feel like doing, serving these customers and checking them out is the right answer because they can't just leave and go on break, right? That would be considered a good faith error. Yes, the individual violated a policy, but they thought they were doing what was right for the company, serving the customers. Okay. Now, let's, again, gray area, let's flip this. Let's say that you had warned them for something like this and you had provided them strategies for how to handle that exact scenario. So say that this has happened before and they've used that reasoning. Well, I couldn't get away. We were shorthanded, whatever. And maybe you say, okay, understood. In that scenario, here are some strategies for how to manage that. Maybe we call over the intercom to a supervisor, or, maybe whatever the case may be. If you provide them strategies for how to manage that, and then let them know that if this happens again, unfortunately, they're going to have to be terminated, and then they choose not to utilize those strategies in said moment, then that could be deliberate misconduct, because you've warned them, you've told them their job is in jeopardy, and you've given them strategies for how to overcome this. And so there's really no reason for that to happen. So that kind of gives you the line there of what could be a good faith error versus misconduct. All right, let's talk about attendance, because attendance is a very frustrating one, I think, for employers, because we all know those employees that just never show up for work. We can't run a businesses if people are not at work. And what I can tell you is that in general, in most states, and they're all a little different, but in general, attendance is going to come down to the final incident that resulted in their termination and whether or not it was beyond the employee's control. Okay. So if the final incident is they were sick, or their child was sick and they properly reported it per your policy. It doesn't matter how many absences they've had, doesn't matter how many warnings they've had. You can't help when you're sick, or if your child is sick and they can't go to school. A person cannot control this. And so oftentimes the state will rule in their favor. Okay. Now, there again are ways or times where attendance is considered misconduct. Okay. So you really have to look at what was the final incident? Was it within their control? Maybe this person is a habitually tardy individual, and maybe you terminated them because they were an hour late for work again. And maybe their reason was my alarm clock didn't go off, or I ran out of gas. These are things that the state would consider to be within an employee's control and a reasonable expectation that they would set an alarm clock, especially if they've been warned before and they knew their job was in jeopardy, that they would make sure their gas tank was full, right? Or that they had enough gas to get to work. So those types of scenarios would result in potentially in misconduct or something that was within their control. And so this is why it is important to actually document and ask the reasons for an absence. I think some employers get a little weird about it, like, oh, I don't think we should ask. No, you should absolutely ask why they cannot come to work. And they should be able to provide a reason to you. Another way that it could be misconduct is if they're not following the policy. So, say someone is sick, but your policy says you need to call and speak with your direct supervisor before the start of your shift, or a half an hour within the start time of your shift, whatever. And say they just send a text message to their coworker, Barb, and say, hey, can you let John know I'm not going to be in today? I'm sick. Well, that would be a policy violation that is within their control. They are perfectly capable of following the proper procedures for reporting their absence and that they were sick. So those are just some things in some gray area with attendance. But what I would say about attendance is document the reasons, make sure you have your warnings in place, provide all of that at the initial protest level, initial response. If the state comes back and the facts of the case are not in dispute and they don't rule in your favor, it is time to let it go. Okay. You're not going to change their definition of what is misconduct. You're not going to prove to them that this person was a terrible person because they never showed up for work. It's not going to happen. So if they acknowledge what you've submitted, okay, and all the facts are in alignment, and they say, we get it, they had a lot of absences, but they were sick, they properly reported it, it's not misconduct, let it go. Now, if the facts are in dispute because the employee is saying one thing, you're saying another, the state kind of has to find some middle ground there, and you feel like there was misconduct and the state has not acknowledged the true facts, that's a different story. Then maybe there's merit there. And then you would want to discuss that with your claims consultant to determine if an appeal should be filed. But attendance is tricky. And it's really just going to come down to that final absence. The other thing about attendance, and actually I would say this about all of your policies, you need to make sure that you are uniformly enforcing your policies. Follow your own policies. So I think what a lot of times people think they're being compassionate and that they're going to get brownie points for this. So, but that's actually not the case. It will hurt you when it comes to an unemployment claim. So say your policy says after 10 absences in 6 months you're terminated, but you really, this person was going through a hard time. You were trying to give them some leeway, and so maybe they had 15 absences, and then you finally discharge them, and you're thinking this is going to help you out. The truth is the state will look at that and say, well, if you don't follow your own policies, how is the employee supposed to know what is expected of them? And so it really works to a disadvantage. You need to follow your own policies and you need to enforce them uniformly amongst all employees. Okay, so let's talk about the last type of discharge that's a little bit tricky. And that's poor performance. Poor performance is actually going to get a slide of its own. Okay, so one of the more confusing, if not controversial, separation issues surrounds a worker who has been discharged for poor performance issues. But an easy way to think about this is wouldn't versus couldn't. So you hired them and they've never been able to perform the skills, they've never met your expectations. That's going to be couldn't perform the job. Okay, that is not going to be misconduct, and you can give them 100 warnings. It'll never be misconduct. Okay, now the difference is you hire someone and for 2 years they've had successful performance evaluations, they've met your expectations, they're doing the job, they have the skills, and then all of a sudden they start performing they start having poor performance, right? Underperforming. Well, now you might have misconduct, right? Because you can show that the person has the skills, they've been performing the job at acceptable levels, their job duties haven't changed. It's not like they got a promotion and then couldn't meet the job requirements. Um, and so if you can prove that, well, then that would be misconduct. So here's what I would say about poor performance. Okay. The state thinks that it is an employer's responsibility to make good hiring decisions, to properly screen for the skills of the job for which you are hiring. So if you hire someone and they're just a bad hire and they never meet your expectations, too bad. It's bad hiring decision. You will be responsible or for their unemployment, most likely, depending on how quickly you separate them. If you hire somebody and they're not meeting the job requirements, uh, if it's feasible, separate them as quickly as you can, right? Because we talked about that base period earlier and how your liability gets determined. And if you separate them quickly, you may not even be in the base period yet. If you're in one of those proportional states, it might all get charged to their prior employer. Or if you separate them, quick enough, you might have only that 10% of liability like company A did earlier, instead of 40% like company C. So definitely don't hang on to poor performers longer than you need to. Now, if you have someone that you think there was misconduct and it was deliberate, poor performance, don't even call it poor performance when it comes time for the unemployment claim. I think what happens is we use this as an overarching sort of just catch-all category. Poor performance can mean anything, right? And so I think sometimes maybe our HRIS systems don't have a lot of specific codes. Maybe we don't want to be harsh with our language and say it was a violation of policy, and so we say unsatisfactory work performance. Well, you can put that into your internal systems and records. But when it comes time for the unemployment claim, look at the facts surrounding the separation. And if you think there was misconduct and that they should not be getting unemployment, you need to approach that claim in a different way. The state is not going to be auditing your HRIS system to make sure codes match. Okay, so you need to make sure that you give the appropriate picture of what really happened to the state. As soon as you say inability or unsatisfactory work performance, poor performance, the state adjudicator is immediately stops listening and starts writing checks. Okay. So we want to use the right language to reflect what really happened. So there's two strategies here. You can either focus on a policy violation that occurred in the final incident. So whatever the straw was that broke the camel's back, whatever triggered you to terminate them, if you can find a policy violation in there somewhere, that is what you focus on. They violated this policy in the final incident. Here's the details. And then here's all the warnings that led up to this. Okay. Um, if it truly just was like they're underperforming because I don't know, they just don't care anymore, right? They've proven in the past that they can perform the job, and for whatever reason now, and you can't pin it down to a specific violation, then use terminology like uh, misconduct related performance or deliberate unsatisfactory performance, right? Something that would indicate that this was on purpose, and then the way to show that is to provide a prior performance evaluation showing that they have performed the job at acceptable levels for a specific amount of time, and now for whatever reason, they are no longer meeting the standards. Um, and so that's what you would do. And so let me give you a specific example of a scenario where in one situation it would be deemed couldn't or inability, right? They're going to be eligible versus misconduct and ineligible. So let's say you hire somebody and part of their job is driving a company vehicle, and you have a policy stating like a certain number of accidents is going to result in termination. Fair enough. Everybody would have that policy. I can tell you though, doesn't matter how many car accidents that individual may have, you could never prove that someone intentionally drove their car into the back of another car or into a pole. Like, I mean, nobody's going to deliberately hit somebody else with the car, right? They're just not a very good driver. So while they may have cost your company a lot of money and insurance claims and things like that, um, there's no intention there. They're just not a good driver. You hired somebody who's a bad driver to drive a car. That is going to be inability to perform job, and it is going to be poor performance, and they will probably get unemployment. Now, on the flip side, if the employee was texting while driving, maybe they were on their cell phone, maybe they were took a cough syrup because they had a cold, and it's a drowsy cough syrup like Benadryl and or an allergy medicine like Benadryl, and made them fall asleep at the wheel, right? Well, now you have a policy violation, right? And in that instance, you would focus on what they did to cause the accident, not their lack of driving skills, right? It's a totally different way to look at it. Because you might be thinking in your mind, this person's had 4 car accidents. They've cost the company so much money. They violated our policy. When in reality, what you should have been focusing on was this person had a car accident because they were on their cell phone. They were not paying attention. They've violated our policy by having too many car accidents. And this was a controllable incident. And so that is how you would want to flip that from, from being inability to being misconduct. And the last thing about this I want to say, and I kind of already mentioned it, but key terms, the key terms you use are so important. So if it is your goal to prove misconduct, don't use words that would contradict that. Don't use words like accident, mistake, uh, you know, inability, anything like that, right? You want to use language that would show it to be deliberate or on purpose. And I can give you a really good example. I was working with an employer that has a call center, and their employees have a policy on call avoidance because their customer service reps, their entire job is surrounding picking up the phone, right? Picking up the phone and helping customers. And so if they're deliberately avoiding calls, they're not doing their job and they can be fired. Well, they fired an individual, we'll call him Kyle, they filed Kyle for call avoidance. Kyle was disqualified at the initial claim level. The employer won. Well, Kyle appealed it and it went to an unemployment hearing. And the state overturned the decision in Kyle's favor. And when we got the decision back, the exact wording was in the employer's own admission, the claimant's mistake was staying away from the phone too long. So it turned from Kyle deliberately avoiding incoming calls to, oopsie, Kyle accidentally stayed away from the phone too long. So I know that sounds really silly and kind of trivial, but that's literally how they look at these claims and make determinations. It's all based on the key terms and the wording that you use to reflect an appropriate situation so that they can apply it to the unemployment laws. So let's talk about effective documentation, right? We talked earlier about the rules that, with the Trade Adjustment Assistance Extension Act and what you have to send to be in compliance with those rules. What is going to be in compliance and give you the best outcomes, okay? So for a discharge, remember the burden of proof is going to be on you. I don't have dates of employment listed here. That's standard. Any unemployment claim, they're going to ask you first and last day worked. Okay. But the next thing that you should provide, and I want you to think about it in this order, is the date and the details of the final incident. Okay. This is not a giant paragraph about what a terrible employee they were and all the terrible things they did. This is nailing it down to one thing. What was the last thing that they did that sort of triggered you to say, okay, we need to separate their employment? So you need to write down the date and the details of what this final incident was. Then you need to tie it back to a policy. So what policy did they violate? Then you need to show that the employee was aware of the company policies. And you could do this in a number of ways. It could be a handbook acknowledgement that maybe they signed off on when they got hired. It could be that maybe they did an online acknowledgement of policies. Whatever it is, you just have to show that the employee was aware or should have been aware of the policies. Because a lot of times, sometimes they'll say, I didn't even know that was a company policy. Well, you signed off saying you got a handbook, you should know, right? And then we want to provide any prior corrective actions or warnings. So that's where we get to show the history. That's where we get to give the narrative of all the prior things that this person has done, which is why you need to be properly documenting them along the way. You need to have everything in this personnel file. Even verbal conversations are relevant. So document the date and the time and who talked to them and what was said and how that went down, even if you're not giving the employee a slip of paper, right? So it's really these things. The witness statements we have listed here, but I'm going to tell you, be very careful with witness statements. Maybe don't even provide them. Everything that you provide to the state for an unemployment case is, uh, uh, what's the word? I don't know why I'm struggling with this word, but basically the claimant will have access to see it, okay? So if a coworker wrote a witness statement and you might be concerned that if the claimant saw this witness statement that they might retaliate against that employee, that could be a bad situation. So I would always caution you to be very careful with witness statements. If it's a supervisor or a manager, and maybe they're not available to attend the hearing, even though witness statements as a firsthand testimony aren't great. At the initial claim level, though, it would be good. But yeah, honestly, witness statements are not, oftentimes the danger of them is not worth the outcome of the unemployment claim. So I put it here, but I would say use with caution because again, anything that you send to the state, the claimant can see. Okay, so really and truly, it's just those four things. It's the date and details of the final incident, what policy was violated on the final incident, how is the employee made aware of the company policy on this issue, and what prior corrective actions and warnings led up to this. So if you provide that basic information on every claim, you should be good to go. You will be in compliance with all the laws and you will get the best outcomes. I can also tell you when I say details of the final incident, do not be vague. Like, don't think that you can say the employee was insubordinate and think that that's enough. It's not. The state will want to know everything. I'm surprised they don't come root through people's drawers. Like they want to know everything. They want to know what was said, what was responded, or how you responded to it. They want to know every detail. So make sure if there is an incident that you write it down in detail. And remember, an unemployment claim can come a year later, year and a half later. So the person who was involved may not be there anymore. And so the details are very important You might also forget over time. So it's worth your time and energy to properly document these things at the time when they occur. All right, we're going to talk about voluntary quits. The hard part is over. Voluntary quits are much easier. So, with voluntary quits, the burden of proof is going to be on the former employee. They're going to have to prove that they quit with good cause attributable to their employer. They'll also have to show that they've exhausted all reasonable options before making the decision to quit. So, what are some situations that could be good cause attributable to the employer? So, the biggest one's probably going to be changing the condition of their employment. So, if you change their pay substantially, their hours, their work duties, anything like that, that could be considered a compelling reason to quit. And let's say you have a small office and your receptionist just quits without notice, and you have a bookkeeper that works for you, and you ask the bookkeeper if maybe she could help cover the phones part-time until you guys get a new receptionist. But maybe that bookkeeper has severe anxiety about talking to people, which is why they chose to be a bookkeeper. You hired them to be a bookkeeper. They work behind the scenes. They don't talk to people. They don't talk to customers. And now you're kind of forcing them to do this other job that they're not comfortable with doing. Well, if you force their hand and you don't give them an option and they choose to quit, right? That could be a compelling reason. That could be changing the condition for the job that they were hired. Um, the other thing would be like an unsafe or hostile work environment, harassment. But the deal here is that it has to be unaddressed, meaning they reported it and you didn't do anything about it, right? If they properly reported it to you and you took the appropriate actions and you can show to the state that you made reasonable efforts to make the environment safer, better for this employee, and that they should have, pardon me, been able to be comfortable at work, but they still choose to quit, that's not going to be held against you. Now, if they just quit and then they claim hostile work environment, discrimination, harassment, whatever, and they never even brought it to your attention and allowed you to address it, again, that's not going to fly. They're not going to get unemployment for that. So, really, harassment, hostile work environment comes down to unaddressed harassment or hostile work environment. Now, I will say some states do have legislative things that uh, will statutory things that will allow someone who voluntarily quit to collect, even though it had nothing to do with you, and even though it doesn't seem like it's fair. But again, there's no pooled funds, there's no tax payments. So if they allow them to quit under these statutory reasons, you will have to pay. So some of those things could be if someone has um, like a spouse in the military and they get restationed, the spouse does, and they have to quit to move with their spouse. As long as they're meeting all the other requirements, they're looking for work at their new location. Did they ask to work remote in the transition? Did they ask for a transfer? Those kinds of things. And if they meet all those requirements and they made all reasonable options, took all reasonable options before choosing to quit, a lot of times the state will allow them to collect. Same with like if there's a domestic violence situation and someone has to flee the area, they can ask their employer for remote work, for a transfer, anything like that, if it's applicable. But at the end of the day, as long as they can show that in their new location, they're meeting all the other requirements, they're looking for work, they're actively seeking work, they're available for work, they're probably going to be eligible in that type of scenario, even though it's not like you as the employer did anything wrong. It's just a statute and you're going to have to pay. The other thing about quits, and I already mentioned this, but I'm going to reiterate, continued employment must be available for it to be considered a quit. So if you did one of those, we'll let you quit instead of getting fired, it is a discharge for unemployment. Again, they're not going to audit your employment records. Totally fine to document in their employment record that they voluntarily resigned. But you need to make sure you have the details in there, because when it comes time for that unemployment case, you're going to have to approach it as a discharge. Because the reality is, if they hadn't quit, you were going to fire them. Okay. So the state is looking at that as, okay, continuing work would not have been available. Therefore, you're going to have to prove misconduct in order to be relieved of charges. All right, what kind of documentation do you need for a quit? Again, so much easier. Burden of proof is going to be on that claimant. At a minimum, all you really need to provide is the, of course, dates of employment and then the reason provided by the employee for quitting. Those are the base things to be compliant with the laws. That's all you have to provide. However, I would highly recommend these other things if applicable. If you can get something in writing that says why they're resigning, it could be a text message, an email, a letter, whatever. Anything in writing is great because sometimes the claimants don't tell the state the same reason they told you. And so written letters of resignation are extremely helpful. Always ask for one. They may not give it to you, but always ask for one. You also need to make a note for your internal records in case it becomes an issue, whether or not they gave notice, did they work that notice, did you allow them to work that notice? Because that's another thing that could come up. If you fire someone, well, let me rephrase that. Let's say someone gives you their 2 weeks notice and you say, thank you so much for your notice, but we're going to part ways today. They will be eligible for that notice period. They might be disqualified after the date that they were originally going to quit, but I'm telling you, if you separate them early, even though they were quitting and you don't allow them to work their notice period, they will be able to collect for that notice period. So if there was notice given, the state will ask about that. So make sure that you've noted if something like that occurred. If you have exit interviews or investigations about job dissatisfactions or harassment or potential, any kind of, these are going to be scenario specific, but all very good documentation to have in a voluntary quit scenario that could be tricky. But again, in general, the only thing that you really have to provide up front is dates of employment and the reason provided by the employee for quitting. But again, strongly recommend a written letter of resignation if possible. The other thing I want to mention is job abandonment. So when someone stops showing up for work, no call, no shows, the states have specific rules on this. So in most states, in order to be considered job abandonment, they have to no call, no show for 3 consecutive shifts in a row. There are 2 states that I know of that require 5 days, and that's New Jersey and Alabama require 5 days of no call, no shows. Know whatever your state's rules are on that. Document the dates that they didn't call or show. Even if in your mind you're like, yeah, they're out of here, you're a lot better off to pursue it as job abandonment and a quit than you are a discharge. So if you can get 3 consecutive days or 5 consecutive days, do it, and then pursue it as job abandonment. Now, if they only no call, no show once, and then you hear from them or they try to come back, but maybe they've got an attendance issue, that's different. That's going to be a discharge for attendance. But as long as they've had prior warnings, right, that final incident would be misconduct. It would be controllable because they did not call or show up for work. So if you don't have at least 3 or more days, it's probably going to be a discharge, right? 3 or more days is usually where you're going to get that job abandonment or voluntary quit scenario. And if you can, send them an email, read receipt, or certified mail, or something that says, we're accepting your voluntary resignation based on these 3 days that you failed to call or show up for work. All right, lack of work. So lack of work is the entire intent of unemployment, right? In general, it's not disqualifying. If you lay someone off, reduce, do a reduction in force, anything of that nature, budget cuts, they should be eligible for unemployment provided they're meeting all the other requirements, right? But let's talk about some of the trickier ones that fall into lack of work. So seasonal workers. All right, seasonal workers, a lot of times we get questions about this. Well, we just hired them for the summer and they knew it was temporary. Same thing goes with like retailers when they hire Christmas help or whatever the case may be. But I'm here to tell you that seasonal workers, when they separate, if they are still actively seeking work and no work is available, they will be eligible for unemployment in most cases. It's considered, lack of work. Basically, I think the reason behind this is because the states do not want to prevent someone from going out and taking some of these temporary jobs. If they told an individual, well, go ahead and take that temporary job, but when it's over, you're not going to be eligible for benefits because you took a temporary job, well, then no one would take the temporary jobs, right? And so the idea is to accept work when work is available. When work is no longer available, it is, and you're still actively seeking work, it's a lack of work. Um, and that's the same with substitute teachers, assignment-based employees, all of that falls under there. But there are some strategies we'll get to in a second. And then you've got part-time workers. So part-time is a little trickier. Um, so there's three categories of part-time work. Okay. So the state lumps part-time work into three different categories. You've got regular part-time, which is you work the same schedule every week. So you hire somebody to work Monday, Wednesday, Friday, 9 to noon, and that is the schedule they work. That would be considered regular part-time. Okay. Then we've got the other two, which are going to be based on business needs. So someone who is part-time working all available hours, their hours are going to vary from week to week. They're not going to be putting restrictions on their hours. They're going to be available and ready to work. They're not refusing work, and they're working everything you're giving them. That is going to be part-time working all available hours. An on-call or casual or assignment-based employees, right? They work as needed. They have no regular schedule. Um, the deal is with part-time, only regular part-time is protestable, okay? Only regular part-time is protestable. These other things, working all available hours, on-call or casual, or even like seasonal employment, the only thing that can be protested for those things is availability. And in that situation, it's not really a protest. It's an issue between the claimant and the state, but you are forcing the state to question the claimant on whether they're meeting the availability requirements of collecting unemployment. So what I mean by that is if you have an on-call worker or a part-time worker and they're working all available hours and they're not getting enough work right now and their work falls below a certain level, so they file a claim, at the time that they file that claim, if they're accepting all work, that is going to be lack of work, right? And now you've submitted that, it's a legitimate claim. But then maybe later you offer them a new assignment or you offer them more hours and they refuse. Maybe you offer them an assignment and they say, yeah, my family and I are going to be on vacation in Germany that week. Or I've decided to take a pottery class at the community center and I'm not available, right? Those then would be availability issues, meaning they were originally eligible, but now you're offering them work and they're refusing it based on an availability concern. That is protestable. The actual separation from work is not. So let's talk about protesting these two things. So when it comes to protesting regular part-time, you have to provide a set schedule, set hours every week in general, right? The state's not going to want to see big fluctuations in their hours or pay. So did the claimant request to be part-time? Do they put restrictions on the numbers of hours that they can work? Has their schedule recently changed and why? Anytime an employee asks for an availability change or they ask you to update their schedule based on new availability, 100% get it in writing and absolutely put it in their file, okay? The employee has to be available and accepting all available work. They cannot be restricting their hours and then trying to collect partial unemployment. Not all states provide relief for part-time work, but the way that the part-time provision works, it's a little complicated. I'm going to try to explain it really quickly. Let's say, and this came up a lot during the pandemic. So let's say someone they work for you part-time, but they have another primary employer that is like the majority of their income. And let's say that employer lays them off, but they're still working for you part-time. So they go out and they file a claim, and their last employer that made them file the claim is this employer that laid them off, their primary employer. But you are a base period employer. They're still working for you. They've got wages. Well, you're going to get a claim. It's not like the employee said, I'm filing against this employer. They just file a claim. The state looks at the base period wages. You're going to get a base period claim. Okay. So, but the way that, you might be thinking, well, they're still working for me. And that's okay. The way that this is going to work is the state's going to look at their base period. They're going to determine their eligibility amount. So let's just say it's 480, like in our example earlier today. So let's say they're eligible for $480 a week, which is roughly to represent about 50% of what they were normally making every week, right? Now, the state is then going to look at whatever they're earning each week. The person is legally required to report any wages that they're earning, and then every state has a different calculation for how they offset that. So if the person falls below a certain level each week, then they might move into a partial unemployment calculation. If they're eligible for a partial benefit, you might have to pay part of it. Like their primary employer is going to pay some of it, you might have to pay some of it too, even though they're still working for you. The only way to avoid that is to offer them more hours, and maybe then their wages go up above that threshold and they won't collect that week. Or you offer them more hours and they refuse, and you report that to the state, which will then question their availability for work because they're not accepting all work. And that is how you would approach that. You cannot prevent somebody from filing an unemployment claim just because they're still working for you part-time. Legally, that's not how it works, okay? So you might be on the hook for a partial benefit, even though they're still working for you. And again, the only way around that is to offer them more hours. In one instance, they start working more hours and they'll be ineligible for unemployment. Or in the other instance, they'll refuse those hours. You can report it to the state, and the state will then subsequently likely disqualify them. Same that availability, we've kind of already covered this. It's the same thing, right? Document all refusals. That even means assignment-based workers, substitute teachers. I know it's a lot. The good news is that within the Shield portal that you use with our claims administrator, there's a link on the left side menu that says, do you have to report a refusal of work? And this is a great feature because most times you've already responded to the claim that came in as lack of work and it's a legitimate claim and this person's collecting. But then you're like, okay, how do I report this refusal now? There's no active claim for me to respond to anymore. You click that link and it will ask you some questions, the information that the state's going to need to adjudicate an availability. And you just hit submit. And then our claims administrator will then submit a protest to the state questioning the person's availability. So that is a great feature. And that is what you would want to do. Another strategy, if you have a lot of part-time or on call assignment-based workers, use your unemployment report as like a recall list. This is what staffing companies do. So staffing companies have people going in and out of assignments all the time. They've got a lot of unemployment liability. So what they do is when new assignments become available and open, they look at who's filed a claim recently and they reach out to those people first. Because again, getting them back to work will allow them to stop collecting unemployment. Or if they refuse said work, you can report that and you can get a disqualification and get them to stop collecting benefits. All right, another strategy, and this is going to be for seasonal camp workers. It does not apply in every state. I am not a payroll expert. I'm an unemployment expert, not a payroll expert, but I do know that in some states, your camp employees are not considered covered wages for unemployment. So what that means is if these employees meet this criteria that you see here on the slide, which I'm going to go over in a second, you should not be reporting their wages on your payroll quarterly contribution reports. You should not be reporting these wages to the Department of Labor. Otherwise, you will be found liable for their benefits because it's a lack of work when the camp is over, and if they don't go back to school or something, they might be eligible. So here's how, so in the states that are listed here, these are the ones that I'm aware of that have this exemption. If you hire full-time students that are just home for the summer, if you employ them less than 13 weeks, and if the camp operates less than 7 months a year, you can exclude their wages from your quarterly unemployment reports. Okay? They are considered not covered wages. That is crucial. And a lot of times we see with employers where they are reporting wages in error. So you want to be really careful about this and making yourself liable for no reason. Another example of that would be like AmeriCorps or federal training programs, training relief programs, where these individuals are not eligible for unemployment, their wages are not covered. You would not want to report those on your unemployment reports because reporting the wages means you're saying it's covered wages for unemployment. So know your state's payroll rules and laws and handle that accordingly. But that's just another strategy for some of you that might have summer camps. Another strategy for lack of work claims, again, we can't protest lack of work, but severance is another strategy depending on your state. Understand the rules for your specific state, they're all different. How the severance is paid can make a difference, again, depending on your state, whether you pay out in a lump sum payment or whether you allocate it for a certain number of weeks, whether you allocate it out into multiple payments. All of that can make a difference. So what you should do is structure your severance programs in alignment with your state unemployment rules. Again, that's going to be kind of more, well, there's also the payroll piece of that, which kind of goes into the summer camp thing. There are also some states that don't consider severance to be wages for the purposes of unemployment reports. Why this is important is because when someone files an unemployment claim, their claim is good for 1 year or until they hit their maximum weekly benefit amount. Okay. But let's say after a year is up, they're still unemployed, or maybe they got re-unemployed or whatever, they file a new claim. And maybe you're still in that base period. Maybe you still got like 1/4 or a partial quarter left of wages in that base period. Well, you're on the hook again for a new claim, right? But what you don't want is for any separation payments that shouldn't be reported to count for their eligibility. So we had an employer once, and this is why I know about this, because again, I'm not a payroll expert. Um, but in investigating this, we found out what the issue was. So this individual had been separated. She was qualified. She collected all of her benefits. After a year, she filed a new claim. Well, in this separation situation with this employee, it was kind of a tricky situation. She didn't get her severance payment until, I don't know, I want to say it was probably a good 68 weeks until after she separated. It was paid in like a lump sum, but they reported those payments as wages, like they would anybody else's wages, to the state on their unemployment reports. So when this person filed a year later for a new claim, those severance payments were included in the wages to make her eligible for a new claim. And so such, the employer would have been out of the base period based on the filing date had they not reported the severance. The severance now made them liable. So now they're paying unemployment benefit liability on a severance payment. And this was in the state of California. So I do know that California does not consider severance to be considered wages. And therefore, you need to be careful about how you report those to the state. The last thing I'll say about lack of work is consider using re-employment services to reduce your liability. If you should be a member of our services if you're on this webinar, and included in your 501 membership are outplacement or re-employment services. So if you have to separate somebody, no fault of their own, and you want to get them back to work quicker, offer them a reemployment package. Just reach out to us. Gary Casey here is the individual that handles those, but any of us can get you connected with him. You get up to 20 packages for free a year, and they can involve resume writing, one-on-one job coaching, access to job boards, things like that. And the idea is to ease that transition to their next opportunity, but to also get them back to work quicker so that they're not collecting so much on unemployment. So know that these services are available to you and utilize them. All right, so some quick tips and appeals for hearings. We won't spend a lot of time on this because as a member of our services, you have hearing representation and support included in your membership. So what that means is you can have an individual that is experienced in unemployment adjudication attend and participate the hearing with you by phone, right? So they're going to prep you for the hearing. They're going to go over all the testimony. They're going to submit all the exhibits, and they're going to offer to attend. Well, there's a thing in Shield where it says, do you want a representative to attend with you? You do have to say that you want. You have to opt in, but it's included. It doesn't cost anything extra, and you can get this representative to attend with you. A couple of quick tips, though, to remember, and again, you don't have to memorize this because your hearing consultant will go over all of this with you. But the main things I want to say about hearings is First-hand witnesses need to attend. You can have as many people attend as you want, but make sure one of those people, if possible, is the first-hand witness, because second-hand testimony is considered hearsay, and they will give more weight to the claimant testimony, no matter how preposterous it may sound. So if there was a supervisor that was directly involved, witnessed the scenario, or knew about the situation, don't just send your HR person, send both if you want. Send HR as well, but also send that manager. If that person no longer works there, doesn't mean you can't attend the hearing. Hopefully, maybe you've got written statements or things, and maybe you can still prevail. But I will tell you that firsthand testimony is absolutely critical for having a successful hearing. So when all possible, have that firsthand testimony available to participate. The other thing is to avoid getting emotional or, or interrupting during the hearing. So the way that it works is the judge will, give you an opportunity to speak first if it's a discharge. If it's a quit, the claimant will go first. Then the other side gets their turn, and there's some back and forth. It is not unusual for the employer to hear the claimant saying things that are categorically false. Do not interrupt, do not interject, do not get upset. Simply have a notebook handy, write down anything that you want to rebut, and when it is your turn to speak, come back to that and absolutely make sure you rebut that testimony. You also want to avoid going on long soliloquies about how terrible, everything this person ever did. You want to talk about the final incident, how that violated your policy, and what things led up to this. What were their prior coachings, right? That is how you want to structure it, just like we talked about with the documentation. Don't talk about, things that happen after you decide to terminate them. A lot of times people can think that's the smoking gun. Like, well, we brought them into the office to terminate them for their attendance, but they became very angry and they threw a chair into the wall and put a gash in it. And yeah, that sounds violent, a little bit crazy, but it's irrelevant. It's irrelevant. You were already going to fire them. Could it come up to speak to their character as an individual? Maybe, but don't think that you're going to rest your case on this, because it's not even going to be relevant to whether or not they're eligible for unemployment. It's why you decided to separate them is what is relevant. So try to avoid kind of going into some of these other details that are extraneous and unnecessary. Last but not least, definitely give a summarization, a final statement at the end, a closing statement, if you will. You and your hearing rep can decide who's going to give it, but there's a lot of back and forth. Things can get kind of muddied during the back and forth, and you want to take this opportunity at the end to re-net it out. Here is what happened on the final incident. This is why we think that it was intentional and it broke our policy. The employee was aware of the policies. They were made aware at the time of hire. They signed a handbook acknowledgement saying that they were aware of the policies, and they'd been warned and they knew that their job was in jeopardy. That is what you want to stick to, and you will have the most successful outcomes that you can. Not everything is controllable. Some cases just don't rise to the level of misconduct, but what we can focus on are best practices to try to control the costs where we can. All right. So, oh, look, I had a whole slide and I forgot to change it. Well, this is everything we just talked about. And when you get a copy of the presentation, they'll all be listed here as reminders, but I did forget to flip the slide. Sorry about that. All right, so we've got, 2 minutes. I actually finished quicker than usual today. Usually I'm behind schedule. I talk a lot. We've got one more question. Will we get a copy of the slides? Yep, absolutely. I believe you'll get a copy of the slides, and I think you'll get a recording of today's presentation. So once again, if you stuck through this hour-and-a-half presentation so that you could get continuing HR credits for your SHRM or HRCI certifications, just fill out the survey that you will eventually get after the webinar, and then give us, 24 to 48 hours. We will get you your codes so that you can claim your continuing ed credit. Well, thank you for spending an hour and a half with me today. I hope that you learned something. I know we can't account for every state nuance, but that's what we're here for. So if you have questions, a specific question about your organization or for your state, you've got a dedicated claims consultant that is dedicated to you. You've also got us here at 501 that can help you get answers. So please reach out to us at any time. We are happy to assist. But with that, I think I'm going to go ahead and close the webinar for today. I hope you guys have a great rest of your day, and please enjoy the 15 seconds I gave you back at the end of this webinar. Have a good day.